And good morning. Thank you all for joining us. My name is Tim Grayson, Assembly member from California, and I'm also Vice Chair of the Incoil Financial Services and Multi-Lines Issues Committee. I'll be moderating this general session. We have a great panel of speakers that are before us here today to discuss a very timely and interesting topic. Now, we've been able to touch on it just a little bit in a few sessions, but now you get to opine on it. And it is the affordability and availability crisis consumers are facing within the auto and home insurance markets. Being from California, I can tell everyone here today that the term crisis is not just an exaggeration. It's reality. And we've been battling these issues for several years in California, but things have really been getting extremely troublesome over the past year or so. So with that, we're not just talking about California today. Unfortunately, consumers are facing affordability and availability problems throughout really the entire country, and it's making headlines, and not just insurance-specific outlets, but in New York Times as well as the Wall Street Journal. So now is a good time to have a discussion and hear different perspectives on how did we get here and how do we fix it. Joining us today to discuss these issues, Christine Ashburn, Chief of Legislative and External Affairs at Citizens Property Insurance Corporation, Paul Martin, Vice President of State Relations at the Reinsurance Association of America, Robert Gordon, Senior VP of Policy, Research, and International at American Property Casualty Insurance Association, as well as Kevin McKechnie, Executive Director of the Health Savings Account Council at the American Bankers Association, and Jay Feynman, Distinguished Professor Emeritus at Rutgers Law School. So to learn more about these speakers, please, you can view their bios in the program or also on the app, and I also urge you to reach out, bless you, to them afterwards and learn about them and these important issues. So in the terms of format, I think it'd be best if we just hold questions until the panelists are finished speaking, and then we can ask our questions. And so let's get started. And if we will, we can hear first from Christine. Please, go ahead.
Good morning. Can you hear me? Great. Thank you for having me. So, as you mentioned, I know California is dealing with some issues, but as all of you are aware, Florida has been in a unique crisis of sorts with hurricanes, but also with litigation issues, and our market has been, unfortunately, not very healthy. And what we always say in Florida is the largest indicator of the health or lack thereof of the insurance market in Florida with property, of course, is the size of Citizens as the insurer of last resort. We do have some good news on the horizon, but I just wanted to give you an idea, probably preaching to the choir for some of you in some states, of kind of where Florida sits and how it works and what we've done to try to mitigate our own problems in our state. So just to kick it off, many states have residual markets, as all of you are aware, but Florida is 51% of the size. We are the largest by far, larger than all of the other state residual markets combined. That's not a number that we hold dear. I'm proud to tell you that 1.22 million number of policies is down to 1.17 million, but we are the largest combined ourselves than everyone else in every other state. Not an honor we hold, but that is the case. And of course we have the coastline, and you would expect that with our hurricane risk, but we've had other factors that have been a real issue for the state of Florida. So just to give you an idea, and I know some other folks are going to speak about the other FAIR plans, but just to give you an idea of where we are and the size and the growth, where compared to other states. We are declining slightly and have not seen the growth at the same level as some other states, but again, not where we want to be. And we're doing what we can, both legislatively and through policy changes and regulatory changes to get ourselves out of the mess we're in. So, like I said, health and lack thereof of the market in Florida is a the size of the residual market is a huge, the best growth indicator and health indicator. And you can see we've been where we are now before. In 2011, we peaked at 1.5 million policies and over 500 billion in exposure. Our exposure has exceeded that number, but we have not exceeded that number in policy count. Obviously, growth in value and inflation and insured value is up from when we were 2011, all those years ago. But we are starting to see some good news. We are budgeting to be a little bit larger than we ended last year, although I will tell you our depopulation program has already exceeded, I think, our expectations, and we've got some revised estimates that indicate we could be back under 1 million by the end of this year, so that's a positive sign. So early signs of our market improvement, OIR has approved 8 property insurance company actions, including 7 new insurers, since the December 2022 litigation and reforms in the property market. We've had no insolvencies since that time, and prior to 2022, we couldn't say that. So that's a great sign. Huge increase in depopulation activity, and I'll show some more slides on that. Current companies are also expanding new business in Florida, and our new non-catastrophe litigated cases being filed through last year, year over year, is down 20% over 2022. Our reinsurance availability in 2023 was much more positive than we anticipated from a capacity, and pricing was about where we thought it would be, but we were concerned walking into the June renewals of last year that we could see as many as 5 to 11 additional insolvencies just because we were concerned that carriers couldn't get coverage below the Florida Hurricane Catastrophe Fund. That did not happen, and that was candidly the first indicator that things might be on the uptick. So state of the market's doing better. We've had lots of red, which is not where you want to be, and I know, insurance companies can take a bad rap for profits and, getting rich schemes. That's not the case in the Florida market. It's been a long road of a lot of red years, but things are starting to look up. We are not out of the red as a market yet, but I will, on the next slide, I believe, I will show you that we are much less in the red, finishing 2023 than we had been in previous years. So here's an indicator. Again, red is not good, obviously, but when you look at where we had been in underwriting gains and losses in the previous 4 years, 2023 was a positive year. Not positive in the black yet, but positive in the sense that our net underwriting losses were much lower. And by the way, this data does not include Citizens. But finally, some positive signs. Net income in 2023 was actually in the black. So obviously, insurance companies are in the business of making money, but for Citizens. And when you look at those numbers as any investor or insurance company leader, you certainly would question why you continue to throw good money after bad in the state of Florida. So positive trend for us, finally. So just a little bit of history. We were talking, my panelists, before we started. Prior to 1992, when Hurricane Andrew hit, you would see on the far left of the slide that the national carriers and the Florida pups before 04 and 05 were about 35% of our market. So that's the State Farm, Allstate, Nationwide. And then we had a domestic market, the Florida-based, which is orange, which was about 22%. We peaked then on the second graph, Citizens in the blue, at 23% of the market. And you'll see our market has shifted greatly. The Florida-based carriers are the lion's share. They're more than 55% of our market. We call those the Florida domestic carriers, many of whom have expanded into other states. Unfortunately, a lot of southeastern states like Louisiana, where we've had a lot of hurricane activity over the last 5 to 7 years. But we don't anticipate seeing the national carriers ever come back, that yellow market, in the way that it was. But I was sharing before the panel, a lot of the national carriers get a really bad rap in Florida, and I don't think that's fair. State Farm is the second largest carrier behind Citizens in the state of Florida, and we have had Farmers exit our market, but State Farm is recommitted to our market and is writing new business. And we do see that market share stable, so that's a positive. Oh, that's in there twice. I apologize. I don't know why that's in there twice. This is an older graph. I apologize. I'm going to skip that one. So what's the positive news? Last year alone, we had 275,000 policies through our depopulation or takeout program return to the private market in Florida. That is more policies than in 2016 through 2022 combined. So very positive. 113 billion in exposure was removed. And you can see on the chart of Florida on the right-hand side, it's a good mix. It's all over the state. So it's positive, right? Every company has a different business plan. And so people always ask us, well, why don't you bundle policies and send them out? Well, the answer is because we don't know what other companies are writing. We don't have access to their records. So it seems great to package policies, but really in actuality, every company has their own model, and what might be good for them might not be good for the next company, and we don't have knowledge of that. So handling them a bunch of stuff in Miami-Dade might be great for one company, but for another company, they may not need to grow in that area. So we've looked at those ideas in the past, and they just don't work. A little bit more on depopulation, so you can see when you look at our history, remember in 2011 was when we peaked at the 1.5 million policies. Well, you can see the depop was bad then, and then the market was more favorable. We went through some years with no storms. There were some minor reforms, and the market expanded, and as the depopulation grows, our numbers shrink. So far this year, this slide shows us at 92,000 policies removed so far this year. That's actually through March. It's 114,000 and about 5.5 billion in exposure removed already. Now, of course, as the hurricane season starts in Florida and the CAT fund and reinsurance contracts are locked in, we'll see depopulation really come to a very slow and halt until after the hurricane season. We'll see carriers be very active again in the fourth quarter of this year. We do anticipate, though, an additional 244,000 policies being removed, although I believe that number probably will be over 300,000 based on how well we've done so far this year and the new entrants in the market. So litigation and assignment of benefits, I mentioned the reforms in Florida. So Florida had a one-way fee statute that basically allowed an insurance company to be on the hook for plaintiff's attorney's fees if you lost by $1. If you went to court and lost by $1, so say the plaintiff was saying you owed $100,000 and we said you owed 10. If we paid $10,001, we owed all attorney's fees. There was no skin in the game with the plaintiff's attorneys. That law was on the books for about 100 years in Florida, and it was repealed, in December of 2022, which of course we have to renew all the policies onto the new policy form following the passage of that law for it to be effective. Due to it, there was a state Supreme Court case on PIP actually that made it clear that you couldn't make changes in contract terms on attorney's fees and other litigation reforms midterm. So following those reforms, and we also had an assignment of benefits problem, and assignment of benefits were repealed for property as part of that legislation as well. So you can no longer assign your benefits. We saw that was a huge issue in non-weather water. It was also a huge issue prior to reforms in auto glass, where you would have consumers who didn't even know that they were named in a lawsuit being sued because we have no deductible for auto glass in Florida, which is a good thing. But that you'd have all these vendors at car washes and other places saying, hey, I can get you a new windshield, or I can get your kitchen replaced because you had a water leak. There's some water here. I can take care of this. Where you had a huge escalation in the volume and the amount of those claims where the third party was standing in the shoes of the consumer. But as you can see through Q4 of 23, we're really starting to see positive trends in those areas. So just to finish out, 2024 legislative changes, I mentioned the big reforms in 2022, additional changes in 2023, and as a part of 2022's big reforms, Citizens, as the state-created insurer of last resort, the legislature made a decision following Hurricane Ian, where we saw incredible storm surge. I'm sure you all saw the stories and the death, and it was horrific. So many people that were impacted by that storm from a flood perspective, a surge and water rise perspective, were not required to carry flood coverage as part of Fannie and Freddie's requirements in those special high hazard zones. So the legislature decided that if you were going to be insured with the state-created insurer of last resort, Citizens, who can assess all Floridians in the event of a deficit because we cannot become insolvent, that you have to have flood coverage statewide as a tiered basis, starting with the high hazard zones, then by coverage A values, starting at 600,000, this year, and then we go to 500 and 400, and then eventually by 2027, all customers of Citizens as a point of eligibility must have flood coverage available through the NFIP. What we didn't know in that past was that the NFIP's policy for contents is a separate policy, and many people don't carry contents. And if you didn't already have a contents policy, you are not under the glide path for rate increases with NFIP, and as such, a new contents policy, if you wanted to carry contents coverage with Citizens, would put you under Flood 2.0, and we saw examples where people were paying more for contents than they were for their dwelling. And so the legislature has opined now that you have to have a dwelling policy with flood. We also have increased the agent appointment requirement with Citizens to ensure that you have at least 3 admitted market carriers writing in Florida in order to have an appointment with Citizens, so that you're not just putting business in Citizens. It also allows us to share data, this new law, with NICB, the National Insurance Crime Bureau. There are some statutory requirements on protection of data with Citizens that prohibited us from sharing all of our data. And as you can imagine, if you're NICB or Department of Financial Services group where they're looking at fraud and abuse, if our data is missing from the data set in Florida, it really doesn't tell the whole story on syndicates and some, efforts amongst bad actors to, for example, we saw claims that we found where the same picture of the same pipe was in like 25 claims, right? So if our data set's missing from an ICB, it really does hinder fraud and abuse work. New surplus lines carriers have historically been not allowed to participate in depopulation, only admitted carriers. This does allow surplus lines carriers to participate in Citizens Depop program for non-primary residents that are also non-homesteaded. For the purposes of Citizens, non-primary means you have to live there. In order to be primary, it's 9 months out of the year, but a homesteaded person is 6 months and 1 day, and so the legislature wanted to be sure that our permanent residents were not being impacted or taken out by surplus lines because they don't have Florida insurance guarantee coverage, and their rates are less regulated. Although in this program, the OIR, Office of Insurance Regulation in Florida, does have rate authority and more governance than you would in a typical surplus lines company, but another avenue for Depop. And then another thing that we've had a lot of roof abuse and fraud and litigation. It allows a residential property owner to cancel a contract to replace or repair a roof without penalty or obligation within a certain time frame following a declaration of emergency. And with that, I know we're going to hold questions in the end, but I'm here for any questions. Thank you.
Thank you for your presentation. We'll move on to Paul Martin.
Thank you, members. Paul Martin, Reinsurance Association of America. Most of you know I live in Austin, but I grew up about 50 miles southeast of here in a little town called Bell Buckle, Tennessee, and I went to college just down the street. So on behalf of my home state, welcome to the great state of Tennessee. Let's jump right into it. A lot of you have asked questions, a lot of your regulators have asked questions about what affects pricing and availability of reinsurance. And there's a lot of factors that go into that. But when we distill it down to 2 things, it comes down to the availability of capital and future expected loss costs. Availability of capital and future expected loss costs. And you're going to hear this theme repeated for the next 9 minutes throughout my presentation. As most of you know, reinsurance is just another form of insurance. Reinsurers are regulated. All of you in some form or another passed the recent amendments to the Credit for Reinsurance Act in 2019. It gives your commissioners a lot of discretion in terms of regulating for solvency of insurance companies. These transactions take place between sophisticated clients, insurance companies and reinsurers. Insurers buy reinsurance because it makes a good business sense to do so. Fun fact, insurance companies are not required to buy reinsurance. They can raise capital other ways. They can issue stock, they can issue debt, but they choose to buy reinsurance because at the end of the day, it is often a better financial decision to do that compared to other options. Now, I've got a couple charts here for you, and I know these charts are busy. They are in your materials. I do want to just compare, let you just see some volatility here. We've got on the top line, we've got the P&C industry market cycle for about a 50-year period. Below that, you have the reinsurance market cycle. The orange line is what I would really point your attention to. That is for the combined ratio. The thing I would want to point out in this chart is look at the difference in the volatility between the P&C industry market and the reinsurance market for the same period. The reinsurance ratio is much more volatile. And what's happening is, as we say down in Bell Buckle, reinsurers are taking the lick for the P&C industry. And that's not a complaint. That is by design. That is what reinsurers do. So when you have the reinsurers absorbing those extreme losses, it creates a much more stable environment for the P&C industry at the end of the day for your constituents and your consumers. This is the second most important thing I'm going to tell you today. And I know the text at the top is small, and I'm going to paraphrase some of this, pull out some keynotes in the next slide so the folks in the back of the room can see it. But I really want to point your attention to the very end of this chart. This is the exposure compared to the capital in the reinsurance market for about a 10-year period. And you'll notice those things kind of track more along in lines, except until we get to 2021. We see exposure for the reinsurers continuing to go up, and we see capital going down. In the two lines, one is GAAP accounting, and one is stat accounting. So exposure going up, capital going down. Availability of capital and future expected loss costs. So this is some keynotes from that text on the top slide. This came from AM Best and Swiss Re. Demand for reinsurance is going up because of increasing cat activity and increasing property values. At the same time, catastrophe claim payouts have reduced the supply of reinsurance capital. Risk appetite has further decreased due to poor property reinsurance underwriting results in recent years and widely held perceptions that risk assessments are underestimating actual loss experience. This is leading to a hesitation on the part of capital providers to commit new funds to reinsurance risk and replenish industry capacity. Reinsurers often issue reports. Gallagher Re is one of those. This is from their 2023 catastrophe report. There's a lot of information I think you need to know and take back to your regulators and to your constituents. 6 of the top 10 costliest global events in 2023 were severe storms in the United States. We had, members, 1 hurricane in the United States last year, and we had 1 tropical storm. When we say severe storms, we're talking about garden variety thunderstorms. 6 of the top 10 costliest insured events globally were in the United States, and they were thunderstorms. 34 individual billion-dollar events in 2023, surpassing their record in 2020. 32 weather climate-related billion-dollar events tied with 2020 as the most recorded in a single year. The United States accounted for 24 of the 34 billion-dollar insured events in 2023 globally. 11 of those were multi-billion-dollar events. Availability of capital and future expected loss costs. As a result, AM Best took the unusual step in September of downgrading the homeowners market from stable to negative, citing here natural catastrophes continuing the first half of 2023, combined with other ongoing market challenges. So, what are some things I think you need to know? So I've narrowed this down to 5 with the hopes of ideas to give you some things to think about and as you have conversation with your constituents and with your state regulators. First and foremost, insurers and reinsurers are impacted by the same events. When insurance companies have large losses, if they have reinsurance, they contact their reinsurance broker and they facilitate payment from the reinsurer for those losses that were assumed by the reinsurer. By transferring potential losses to the reinsurer, insurance companies can then write more policies. It creates capacity in the system. Number 2, many challenges are happening simultaneously. And this is the recurring theme that I hear when I talk to people who've been in the industry 20, 30 years. And that is this. We're seeing increased frequency and severity, construction cost inflation, interest rates, supply chain issues. And members, the problem is all of these things are happening at the same time. And when I talk to people who've been in this business 20, 30 years, what they tell me is, Paul, if it was just increased frequency or severity, if it was just inflation, if it was just interest rates, the market could figure this out. We could make this work. We've never seen this happen. We've never seen all these things happen simultaneously. And that's the challenge that we're seeing in the marketplace right now. Number 3, focus on what you can control. So if I go back just one slide, of those things, how much can the reinsurance and the insurance industry actually control? I've been talking about future expected loss cost. And if we were to drill down into that, what's driving future expected loss cost? the two things that always come up to at the top of the list are the weather and the cost of building materials. Our industry has zero control over either one of those things. So as policymakers, I would suggest we need to focus on the things that we can control, including but not limited to some of the things that you've heard here today and you've heard in previous INCOIL meetings: building codes, land use laws, how we build and where we build will matter in the future. Setting up of mitigation funding. Alabama and Louisiana are being real pioneers in this. I know other states are looking at this well. Coming up with ways to improve the stock of existing housing, particularly for those folks who may not be able to afford to get a new roof or do the mitigation they need to do. Underwriting and rating flexibility, allowing companies to adjust their book of business and adjust their risk as they see fit on a state-by-state basis so that they can deploy capital in the best way they see fit to help the marketplace. And fair claims handling, balancing the need to protect consumers with the need of insurance companies to resolve claim disputes quickly and fairly and without unnecessary penalties, attorney's fees, and litigation. Number 4, this is the most important thing according to my members I need to share with you today, and that is catastrophe funds are not a solution. Catastrophe funds go by lots of different names. You may hear as reinsurance pool, cat fund, those sorts of things. In the traditional reinsurance market, a reinsurer may take some tsunami risk from Japan, may take some hail risk in Texas, some flood risk perhaps in Europe, some severe weather risk in Australia. Those are uncorrelated risks, right? And they are spread out geographically. And when you do that, you can reinsure those risks much more cheaply than you can if they were consolidated. What a state government cat fund does is it takes all the risk in a relatively small geographical area, a state or several counties. They're all the same risk, either hail, wildfire, whatever we're reinsuring for. And we're requiring the citizens of your state to constantly put money into it, right? Because when the state reinsurance fund ends up being depleted, money has to go back into that reinsurance fund. And with traditional reinsurance, when the reinsurer pays the insurance company doesn't have to pay that money back to the reinsurer. But with a cat fund, a state government cat fund, at some point, your citizens end up acting as the reinsurers for the private insurance market. So I want you to be aware of that problem. I just don't think you're going to be happy with the result if you decide to go down that road. Finally, and I say this to regulators as well, anytime you're looking at a new piece of legislation, new regulation, ask yourselves, will this encourage or discourage new insurance capital from coming into your market? All of these things have a cost, all these things have an effect, but that's this question you need to be asking first and foremost. Will it encourage or discourage new capital coming into your market? So, insurers and reinsurers are impacted by the same events. These challenges that we're facing are all happening simultaneously, and this is unprecedented. Focus on the things we can control. Catastrophe funds are not a solution, and ask yourselves, will this encourage or discourage capital? And I will conclude very quickly by saying this. I know yesterday were some comments made about a meeting that happens annually in Monte Carlo with reinsurers. I can tell you that those meetings are very similar to meetings that we have here at INCOIL. They've been going on for a long time. Experts from banking and finance and weather and mathematics come in and do presentations. Reinsurers and their clients meet there to start to discuss renewals ahead of the January 1st renewal. There's been no reason that we know of to think that there's anything improper happening at those meetings. But if you have information, and I would say this to a regulator or to anyone else, if you have information you believe of impropriety, of collusion, I highly encourage you to contact the Antitrust Division at the U.S. Department of Justice. And if you have any questions about how to do it, please let us know. It is a huge concern when we start every meeting at the REA with an antitrust statement, as do the other trades. We are more than happy to facilitate any sort of conversations you want to have to report what your concerns, because we do take that very seriously. Thank you.
Thank you, Paul, for your presentation. We will now go to Robert.
Well, thank you for inviting me to join you today. I'm Robert Gordon, Senior Vice President for APCIA, the American Property Casualty Insurance Association, which represents most of the home auto business property casualty insurance industry. So insurers' mission is protecting people and helping them recover from catastrophic losses, and I'd really like to be here today to tell you how strong and stable our industry is. to fulfill our mission. Unfortunately, I can't. Property casualty insurance markets have been rapidly deteriorating in many states, particularly, as you've heard a little bit already, in California, Florida, and Louisiana, where insurers have suffered deep losses. And in many states, regulators have tried to suppress or delay rate increases, and that has turned affordability challenges into an availability crisis. Primary insurance capital plummeted more than $73 billion in 2022, and it still hasn't recovered. $73 billion contraction. Reinsurance capital similarly contracted by 12% of the global capital supply. And for 2023, ratings agency S&P predicts auto insurers are going to have an 8.7% net underwriting loss, and homeowners a 12.1% loss, the worst in over a decade. The NAIC just released their latest property casualty insurance profitability report for 2022, and it underscores how bad the depth of losses in the industry are. Personal auto insurers lost more than $1.12 for every dollar collected in 2022. That resulted in a negative return on net worth of 2.7%. Homeowners insurers had a 5.3% net underwriting loss, barely made it into the black on net worth nationwide. The NAIC in their profitability report, they compare that to the broader commercial sector. The broader commercial sector in 2022 had a 17.1% return on net worth and a 10-year average of 15%. If you're an investor, where are you going to put your money? Look at that chart and say, where are you going to put your money as an investor? And that's what Paul was saying. You're not going to get any new insurance capital with that kind of losses. If insurers are not allowed to be profitable on their core underwriting business, they can't get new capital. Heavy industry losses in 2022, unfortunately, were not an aberration in several states. So again, this is from the NAIC just released report. Over the last decade, California homeowners insurers had a 13.8% loss in homeowners over the last decade. Florida insurers had steep underwriting losses in both auto and homeowners. And then look at that last bar, Louisiana. Louisiana homeowners insurers over the last 10 years, auto was a 7.6% loss. Homeowners was 37.2% loss. I mean, that is just staggering. When you're in a hole that deep, some people stop digging. That's why those three markets are in a crisis. It's because the losses and expenses far exceed the rates. I think Paul briefly mentioned this, but I'm going to go a little deeper. As a result of these deteriorating conditions, AM Best last month, for the first time ever, downgraded the entire personal lines home and auto insurance industry from stable to negative. They cited 3 consecutive years of $21 billion to $40 billion in underwriting losses, and they said underwriting profitability for home and auto insurers in the near term is highly unlikely. Our challenge is very simple: supply and demand economics. The costs and exposures are rapidly escalating much faster than the rate increases. And an industry losing money on its core activities is not going to attract new investment capital. So as a consequence, the surplus capital has declined while other forms of capital like reinsurance have become more costly and limited. So now there's not enough capital to cover all of the increasing coverage needs. That's why you're seeing friction across the country. Now, I know your constituents are frustrated about inflation, and I'll tell you, I am frustrated, I am angry. Every time I go in a grocery store, every time I fill up my car with gas, I'm angry at how much the prices have increased. And I'll tell you, insurers are similarly angry and frustrated at how much our prices, our input costs, have gone up. And in most cases, they've risen higher and faster than the rates over the last several years. So the left graph is auto insurance. You can see the dotted lines are the cumulative cost increases in the cost of vehicle and parts, which have climbed much higher than the solid lines, which are the producer price index, which reflects what insurers actually receive. It's not the urban CPI that often gets reported about what urban consumers pay after taxes and after commissions, but what insurers actually get is lower than those costs. Now, part of the problem is these cars are a lot more expensive now to buy, $10,000 more than they were just 4 years ago. They're a lot more expensive to repair. That right graph, the lower line, is what a car in 2014 cost to replace over time, to repair. That upper line shows how much more of a gap, how much more it costs now. All these great cars with all this technology, electric vehicles, a lot more expensive and even more expensive to repair. And this left graph shows the increased vehicle repair costs over the last 15 years, and you can see just over the last 3 or 4 years how steep that cost increase has been in repairing cars. And the right graph is essentially the cost of repairing people. It's the dramatic increases in medical costs from auto accidents. So when your constituents want to know why have auto rates been increasing, well, it's because the costs of healing people in auto accidents, the cost of replacing and repairing cars has increased even more. Repairs now require a lot more parts. It requires a lot more labor with all the technology. It's much more expensive materials. The repairs take a lot longer to do all the calibrations and of the sensors. There's a shortage of skilled labor in the repair shop, so those delays are getting even longer. Insurers then have to pay for longer rentals while the cars are being repaired. So as a society, it's a great benefit that we're getting safer and more environmentally friendly cars, but it's not reducing the claims frequency, it's not reducing the accident severity, it just makes the costs go way, way up. And auto insurance is ultimately a pass-through of those costs, which again have been rising much faster than rates. On the homeowner side, you hear a lot of false political narratives about, well, it's just about climate or insurance profitability. Well, that's not shown by the facts. The hard facts or the primary cost drivers for increasing property insurance losses are the increase in exposure values in high-risk areas and increased inflation in the cost of building replacement, as Paul talked about and Christine talked about. So it's more houses in the wildland-urban interface, it's more houses in the coast in Florida, it's more expensive buildings, and anybody who's tried to get a contractor to come in and repair their homes knows it's a heck of a lot more costly now with all those building supplies. Climate change, increasing weather severity is a factor that gets more relevant over the long term, but less in the short term. And legal system abuse and excessive regulation are also driving up and compounding the increase in prices. So just to dive into that a little bit more, the left graph represents the dramatic increase in global natural catastrophe losses over time. It's roughly doubled over the last decade, and a majority of those losses, as Paul alluded to, have been in the United States. But the right graph shows the cost to replace all the properties in the United States. And look how much that's increased over the last few years. That is what's driving the cost in property losses. It's the increased rebuilding cost, more expensive homes that are more expensive to replace. While housing and construction costs have gone through the roof, the money insurers collect to pay the claims hasn't kept pace. So in the left graph, the dotted lines show the surge in home values and construction costs since the pandemic, and you compare that to the solid yellow line reflecting the more gradual and lagging increases in premiums based on the Bureau of Labor Statistics Producer Price Index. But the rebuilding inflation isn't the only cost driver. So the right graph represents the percentage of new homes built in each decade that face significant wildfire risk. And look again how much that's increased. People are now building a whole lot more homes in areas that are prone to wildfire risk. Now, that's ultimately a land use, land management decision. But if people are going to move into high climate risk areas, whether it's prone to wildfires, floods, hurricanes, or tornadoes, you're going to end up paying a lot more for insurance long term. It's not going to be uninsurable, as some people have suggested, but without better land use management, without better mitigation, it's going to become decreasingly affordable. Christine and I have both mentioned legal system abuse. You can see how much that's worsened following a short respite during the pandemic. With increases in jackpot nuclear verdicts and class actions, very steep. That legal system abuse has been particularly pernicious to consumers in Florida and Louisiana. According to the Office of Insurance Regulation in Florida, Florida had recently only 7% of the homeowner insurance claims nationwide, but 76% of the homeowner lawsuits. And I'm going to steal Christine's slide for my next presentation, showing that post-reforms, That has improved, and we do see a lot of our national carriers now rethinking about maybe they will come back to the market. There is interest. There are companies coming back in because of those legal reforms. Before those legal reforms in Florida, the study showed that the insurers ended up having to pay tens of billions of dollars in these lawsuits, and the majority went to the lawyers, not the injured parties. And Louisiana consumers have also suffered mass legal fraud, particularly after Hurricane Ida. And so there was, for example, a record $2 million fine against a law firm for illegal insurance schemes involving roofing fraud and assignment of benefits, which Christine also talked about. So, Florida cracks down on legal system abuse, and the lawyers go over to places like Louisiana to do the same thing. While building inflation, climate change, legal system abuse, those are the primary cost drivers. But when you look at the worst market failures, insurance market failures over the course of history, they're caused primarily by government overregulation, particularly rate suppression. So again, three most dysfunctional insurance markets have been Louisiana. You've seen over 24 insurers withdrawing or going insolvent in just the last 3 years. Florida, Christine again had some great graphs I'm going to steal in the future. Florida went from 94% of their homeowners insurance was written by national insurers down to only 18% following the rate suppression in the 90s and after Hurricane Andrew in the following decade. And they still haven't recovered. So the legal system abuse was stopping companies from returning, but the reason they left in the first place was the rate suppression. And then you get to California, which is currently collapsing more than any other state. You have a majority of the top homeowners insurers and several auto insurers pulling back or exiting the market in just the last year, and it's because of the refusal of the insurance department to allow timely rate increases. So you think about, I mentioned going to the grocery store and the gas station. Yeah, consumers get angry, but at least they can adjust their prices on a daily basis. Well, in California, during a period of 40-year record inflation, the department went for more than 30 months without granting one single rate increase for auto insurance. So what are insurers supposed to do? They're hemorrhaging losses and they can't get a rate increase. Well, you can imagine what they do. You're in a deep hole, you stop digging. Rates are now being approved, but at negotiated levels, and you can see from these charts how much those delays have increased. And it's not endemic to just Prop 103 either, because Prop 103 talks about expedited timely rate approval, 60, 90 days, and you can see how much those have climbed. So now it's taking on average a year to adjust your rate. So grocery store can do it in a day. Insurance, if you think about how long does it take to see these trends, document it, file it with a commissioner, wait for a year in California to get it approved, and then your policies are 12 months. So you have to wait for up to 12 months to actually implement it, and you're 2 years behind. And that's one of the reasons you're seeing these steep rate increases now, even though inflation has slowed. It's because of that lag time. They're still trying to catch up, especially in states like California, where they've gotten so behind. And I'm going to be fair here. The commissioner in California, he did acknowledge, and he got it right on the mark. He said insurance companies will not write insurance, especially in high-risk areas, unless they are able to ensure they have the capital and reserves to fully meet all the claims submitted by consumers, cover their expenses, and earn a fair return. So he's absolutely right. It's just not happening yet. We got to get there. Not surprisingly, where you have this regulatory rate suppression and you have the costs escalating faster than rates, then you get these government-subsidized residual markets that Paul and Christine both warned about, and they're generally dangerously exploding. Now, consumers don't get as good coverage. I mean, Christine does a great job, but you don't get the same breadth of coverage or flexibility or options in the residual markets that you do in the private markets. For the insurance companies, you're competing against subsidized competition, and in some of the states like California, if you haven't exited the market and there's another big wildfire, which California will eventually have, guess who has to pick up the tab for that underfunded, essentially insolvent residual market? It's the insurance companies, and they're not even allowed to pass it along. So it's this game of musical chairs where everyone's just waiting for the death blow from the potential failure of the residual market. And so if you're an insurance company deciding, gosh, do I want to do business in California? Well, when you have the president of the FAIR Plan in California warning about this massive exposure and people calling it a ticking time bomb, that's something you have to think about.
And you have about 2 minutes.
Almost done. So overall, insurance market simple, demand and supply imbalance. Demand is increasing, more expensive cars, homes, inflation, legal system abuse. The supply is decreasing, and it's that mismatch between demand and supply for insurance capital. That's why the credit rating agencies have downgraded the entire homeowner insurance sector, why there's availability crisis in some of these states, and why you see some pullback in the market. This left graph shows the declining ratio of the supply in insurance compared to the US GDP as a proxy for increased demand. So in other words, less capital for more demand. Paul and I have the same graph there on the right side. Again, that line going up is the demand. The lines going down is the supply. And that's the mismatch that's creating the coverage gap. Last thing I want to say is on solutions. So short term, the market's not going to stabilize until we close the gap between losses and rates, but we are promoting long-term solutions for reducing costs. Insurers fund the Insurance Institute for Business and Home Safety. They've developed great fortified building standards, science-based wildfire safety standards. We're working on infrastructure improvements, land use planning, controlled burns, defensible space. There are solutions, and those solutions are shown in Florida with Hurricane Ian to have enormous benefits in reducing the costs for consumers and maintaining affordability. And we have a table in here for you analyzing the cost-benefit ratio of various environmental mitigation efforts. The most cost-effective ones are requiring new buildings to meet the stronger building code standards, savings potentially of $11 for every dollar spent. We also have a number of solutions for smart home loss prevention devices, water leak detectors, electricity monitors, as well as using technologies like artificial intelligence that can help reduce expenses. So there are long-term solutions to bending the cost curve and making it more affordable. We're committed to those. We want to work with you on those. But as I've been trying to show, suppressing the rates is not the solution. As Paul said, trying to create these government-subsidized, underfunded competitors is not the solution. Letting the market work is the solution. These are insurable. We do have solutions, and we look forward to working with you on those. Thank you, Mr. Chairman.
Thank you, Robert. And Kevin, you're up to bat.
Well, good morning, and it's a relief that the conversation has been so light and airy so far. I'm afraid that seriousness must intrude, and I apologize for that. The opportunity to pile on is irresistible, and you have all the insurance knowledge you need at the table, and so I thought I'd focus elsewhere, and we'll continue the discussion of Basel III Endgame regulation of capital, since it figures so large in the underlying problems everyone has, and I'm PowerPoint free, apologize. And so I'll say this, the metrics you need to understand that Robert discussed about attracting capital are real, because when you come to insurance meetings, you get the idea of filling up a capital bucket as though this is just so much sand lying around and someone gets a shovel and off you go. That is wrong. What's going on, and I'm trying to make this the most pointed example you could understand. In every one of your states is a public employee union pension plan. And every one of those people, and I have been one, survives under a fiduciary obligation to look for the best return for their future retirees. Now tell me why, and I'm going to ask the same question Robert did, why would they invest in an insurance company? Why would you do that? Could you be sued for doing that? Is it bad enough at this point that that would be something that could happen to you? We can leave that question aside because I can't answer it, but I pose it as something you might want to think about for the future. Where are we? You talked about inflation. Everyone so far has talked about inflation. Yesterday, talking about the Basel regulations, I asked all of you to imagine 10 dimes on the desk. I'll ask you to do that again. And let's assume those 10 dimes can buy this bottle of water. Well, If that bottle of water and those 10 dimes had been here in 2019, you only have 8 dimes left. The cumulative inflation rate is more than 22%. And so you don't have enough money out of those 10 dimes to buy that same bottle of water. Take another 4 away, and you have the cumulative inflation rate since 2004. So the value of the capital that all of these people need is going down, and it's going down dramatically. How fast is it going down? Half of the degradation of the capital has occurred in the last 48 months. In other words, it took 14 years to do what the last 48 months has done to the value of your dollar. Filling in that bucket of capital sounds much worse now, doesn't it? And I know we don't know whether to laugh and cry. I'm sorry, I think I'm going to provide the decision breaker here because the rest of the economy is not doing so well either. But this is a good time to have the meeting. CBO, the Congressional Budget Office, just talked about, and I'm sure this works in your legislatures too, what are things going to cost over a 10-year budget window? What they say is the public debt in our country is going to be 116% of GDP, which is to say, we will work an entire year and still not have enough money to pay all of our cumulative creditors back. To the question of where do you get money for public companies, public cat funds, you more than likely have to add that metric to find out where you're going to get the money anyway. It doesn't exist now. It's not going to exist 10 years from now. Can we earn our way out of it is the question the CBO report poses. In other words, will the economy grow faster than the debt? We don't know. Treasury Department, more good news, not to be outdone, said that wages grew 1.7% from 2019 to 2023. Well, at 22% in that same time period, that's why chicken is so expensive. That's why gas is so expensive. That's why houses are so expensive. And the people we're expecting to buy these things can't. They don't have the money. Federal Reserve, jealous that the other regulators had depressed the country, so decided to issue something else. They said that 37% of our fellow Americans can't afford a shot $400 bill. Gentlemen, has the average price of insurance gone up more than $400 since 2019? Christine?
Absolutely.
Well, there you have it. So more than a third of the people in your states can't afford the insurance that they need to buy a house if those increases were $400 or more. What do you do about it? And the way you do about it, I think, is why you were nice enough to have me. And there is no magic, at least from my chair. But I offer something that might be more optimistic than where we've gone so far, and that's not going to be very hard, I assume. But let's start here in a different place. I'm also the executive director of the Office of Insurance Advocacy at ABA. The sign says health savings accounts. There's a good reason for that, and I want to tell you a little bit about it. We're in the 20th year of HSAs. And after 20 years, there's 37 million accounts. They have $123 billion in them. And they cover a little more than 75 million Americans, which is 1 in 3 workers. That's a lot of people. And that's a lot of people you need to pay taxes because they're in the workforce. 26% of all those dollars, about $13 billion a year, comes from employers because these are employee benefits. And so you put money in, your aunt can put money in, but your employer puts money in. And this is huge, especially for public employee unions, which is where we started the conversation, because what's an insurance policy? Well, and I don't mean to be pejorative, gentlemen, so don't beat me up, but it's a book like this full of promises, and you will get paid, but you have to hit the gates. Unions would much rather negotiate for actual money. How much money are you going to put in my HSA? Well, imagine if you had health savings accounts for property and casualty insurance, and we call them disaster savings accounts. And you let people put money away tax-free. You let it build up over time. You allowed it to come out of the account tax-free if they used it to mitigate problems with their home or their apartment, meaning go ahead and reinforce your roof, buy a resilient roof, tie down the structure, get a new base flood elevation certificate, buy a foundation vent, reinforce your windows or buy storm-resistant windows. All of this is part of the possible because we already have a roadmap, and good news, there's no such thing as ERISA in homeowners insurance. So you don't have to fight with the federal government. and figure out who's actually in charge. It's exclusively a state-regulated set of products. Opportunity is knocking. Is it going to fix it? Won't help you this year if we had it. It won't help you next year if you had it, but it'll help you over time, because as we sit here, there are no Americans that have money in the bank for their next policy renewal for their homeowners insurance. Not like people with health savings account qualified insurance. They do. $123 billion for what's coming. You want this. We want this. We need this. Because these companies are going to do everything they can to attract capital. We have to do everything we can to incent people to save for themselves and make it an employee benefit so the huge employer engine starts giving money to people as part of their compensation. And they will spend it differently. I can prove that to you. We can go to dinner tonight and we'll use an expense account. And then tomorrow it's on you. Where will we go differently? Exactly. People spend money differently when it's theirs to spend. They spend it more judiciously, and there's contemplation. I was invited to do what these people did. They do it way better than I do. That's my contribution, and we can answer a number of questions, but the appeal of this has allies, and I'll finish this way, Mr. Chairman. Next week, the Federal Emergency Management Agency is going to hold a financial resilience roundtable, to which I've been lucky enough to be invited. And it's not because I'm an expert in how to recover from storms. It's because we know a little bit about money and we know a little bit about the economy. And we know how people act when they're under stress. And the average FEMA payout in the last 9 years was only $3,522, which isn't even remotely enough money to get your life back together. It's the money the government gives you as the extra add. And if you know about those kind of payouts or charitable giving, you know that about 48 cents of all those dollars go to fraud. And there's a lot we can try to do about it. And as financial experts, we have systems and technologies in place that do something about that. There's been a revolution in those anti-fraud technologies. And if you can get disaster savings accounts, put technologies like that on top of it, and everyone can put money in those accounts for people to use when there's problems, eventually, over time, we might get somewhere. But it'll certainly be cheaper than airlifting pallets of cash from Washington and dumping them wherever the next disaster might be, which is our current model. That's how we do it. There's probably a better way. Happy to answer questions, and again, thank you for inviting me.
Thank you so much, Kevin. And Jay, it's up to you at this point to get us out of this storm.
Yeah, I'm going to sort of do that, but sort of in the sense that we want to talk about problems, we want to talk about solutions. I don't have the answers. I actually do have some of the answers, but it's not what I want to talk about today. But what I tell my students is if you don't ask the right question, you're very unlikely to get the right answer. So I want to ask what I think are some good questions about this issue of and availability, and we can use it as a framework for thinking about the problems that have been outlined and that you're all familiar with. So the first step in asking a question, what's the problem? Obviously, national problems in individual markets. Assemblymember Grayson, I'm sure gets calls from constituents. I've been dropped by my insurer, and I can't get it from anywhere else. From a policy view, social policy view, that's not the problem. The problem is, at least in some areas in California, there are a large number of properties at significant risk of damage, and premiums are not set under current policy structures, either by the companies or permitted by the regulators that will match supply and demand. That's a much more general problem than the constituent can't get insurance. Other things like that, and let me expand on that in a number of ways. So one of the things we want to know is what's causing the problem. And particularly I'm focused on homeowners insurance, applies to auto as well. We know lots of things are causing the problem. Physical environment. We're talking about wildfires in California, climate change, market factors, the economics of the insurance industry about which you've heard a lot, regulatory issues. Assembly members focused on the question of fire management practices, which contributes arguably the problem. Social factors and so forth. Most of these problems have more than one cause, but you want to separate out those causes and weigh them before you think about solving the problem. The other thing I would say, because it comes up often in these debates, as it came up this morning, you want to focus on real significant causes only. So go over the history of insurance in the past 40 years. Whenever, it follows the political slogan, never waste a good crisis. Whenever there's a crisis, we hear about legal system abuse, need for tort reform, medical malpractice strikes, and so forth. I don't want to debate that today, but what I suggest is when you hear arguments of any kind about the causes, what you want to do is you want to look at data. You particularly would like to look at data from independent sources, or if not available from both sides. For example, we heard correctly, Florida has about 7% of the national homeowners insurance market. Over a recent period of time, they had 76% of litigation filed against insurers. In the same period of time, Florida, 7% of the national homeowners insurance, had 65% of the complaints filed by insurers to their insurance commissioners against their insurance companies. So was there a problem with lawyers? Maybe. Was there a problem with insurance companies? Maybe. We just want to know that. So we want to get focused on the real significant causes. Okay, what's causing the problem? What kind of problem is it? Obviously, climate change, long-term problem. Inflation, significant problem, probably more of a short-term problem. Not a trivial problem, but a short-term problem. Demand surge after a catastrophe in a particular area, also a short-term problem. And I also like to focus on transition problems. As we think about answers to big problems, we have to recognize that people are where they are, and they have settled investments in their property. So we might decide, yeah, we really need to charge more for insurance, and we need to charge a lot more. But the people who've ordered their lives on paying roughly a certain amount on insurance can't see that number jump radically. It's why NFIP, for all its problems, at least has a phased-in price increase because we need to deal with that transition. How big is the problem? Big problems, small problems, obviously. Okay, problems. So we know what the problems are. We have a sense of what's causing them. What are the solutions? I'm not going to offer them, frame the questions about them. What's the best solution? And I will go through these in some detail. We might do nothing. Sometimes that's appropriate. We might come up with non-insurance solutions, but because we're all insurance people here, we want to talk a lot more about insurance solutions. So one thing we might do is we might do nothing. We should let the losses lie where they fall. Neither the market nor the state, the government, can help everybody out of everything, and we have to decide where we're going to balance this. One of my all-time favorite quotes, the least likely thing you expected when you came to Nashville this weekend, from Oliver Wendell Holmes Jr., the Supreme Court Justice, son of the poet, in his book, The Common Law, most important book in the history of American law, published in 1881. The state might conceivably make itself a mutual insurance company against accidents and distribute the burdens of its citizens' mishaps among all its members. There might be a pension for paralytics and state aid for those who suffered in person or estate from tempest or wild beasts. The state does none of these things. Highly individualist notion, 1881. We no longer believe that. I mean, we quite literally provide state aid for those who suffer in person or estate from tempest. It's called FEMA. We quite literally provide a pension for paralytics. It's called Social Security Disability Insurance. Whenever we think about these, we have to balance what we owe to each other collectively against what losses we're going to lie on individuals. And I'm not offering the answer to that. It varies across the board. But we have to recognize that's fundamentally an issue. Okay, non-insurance solutions. What can we do? We heard a lot about that. We heard a lot about that in the previous section of the Property Casualty Committee. For example, subsidies. Provide subsidies for people to strengthen their homes. Provide market incentives. Say people who strengthen their homes are going to get a discount on their homeowner's insurance. Or provide direct regulation. If you are building a home today, in certain areas. You must comply with higher standards than you would have 10 years ago. All kinds of non-insurance solutions that we ought to consider. We're insurance people. We'd like to talk about insurance solutions. Mostly when I say I like to talk about insurance, you know, I can clear out a room, but not this room. So insurance solutions. One of the things we want to focus on is the extent to which we have a model of insurance which doesn't always apply, right? So what is insurance? Insurance is a risk transfer and risk spreading mechanism. What do we need for a risk to be insurable? It has to be calculable. You have to figure out what the risk is going to be, at least over the long term. It has to be non-correlated. We heard that this morning about reinsurance, right? Because then the calculation doesn't work. And it has to be at a level at which we could link price and demand. And therefore people can sell it. Classic model of insurance, but as I say, departed from in many circumstances. Okay, what are the goals of insurance? That's an odd question to many people. Because if you think of insurance as risk transfer and risk classification, it's obvious. It's to transfer the individual risk to the pool to protect the individual against a loss that it could not bear at a current moment. That's not really the case, though, for many types of insurance, because they have social policies beyond risk transfer. So, government insurance, Medicare. Medicare is not just about risk transfer. It's making sure people of a certain age, I'm in Medicare, so I don't like to talk about the elderly. People of a certain age have medical insurance. The Affordable Care Act. Affordable Care Act is extending health insurance to large numbers of people, even though they could not otherwise afford insurance, and making sure that insurance meets certain social needs, like it's really good insurance for lots of people. Auto insurance, which you all regulate in one form or another. Auto insurance obviously provides protection for the auto owner against damage to the car and the potential liability costs of injuries to others. Auto insurance from a broader policy level also provides a basis for the tort system. Provides a basis for the tort system at a level which is too low in most states because policy limits, mandatory limits are low and most people buy no limits. But at least it's something else than just dealing with the relation between insurer and insured. Okay, so we want to know what we're trying to do. What's the pool? And we know there's different ways of composing the pool. Paul points out correctly, you don't want the pool to be too narrow because then you violate the basic principle that risk should be non-correlated. But think about a number of these. California Earthquake Association, the pool is property owners in California. National Flood Insurance Program, the pool is property at risks of flooding across the country. The proposal from Congressman Schiff of California, the Insure Act, let's put lots of cats in one pool. Wildfires, severe storms, wind, hurricane, floods, and earthquakes across the country. Broaden the pool still farther. Again, not recommending one or another, but keep open to the possibility that there are lots of different ways of doing it. Within that, what's the risk classification? So we know insurance companies charge different people different prices based on different levels of risk. We also know there's no such thing as a perfect actuarial risk calculation. It's always an approximation, and for the insurer and for the social policy, we want to know what we can take into account and what we can't. So compare life insurance and health insurance, right? Under the Affordable Care Act, what are the risk classifications that are relevant? Age, gender, tobacco use, geography, that's about it. Under life insurance, under many policies, much more detailed. Insurer wants to know your detailed health history, your smoking use, your alcohol use, may require a medical exam. That has consequences that I'll talk about because one of the things it applies to is how we set the price. So the price for the insurance in part, is going to be based on the risk classification. We're going to charge, under life insurance, presumably healthy people less than people who have significant medical risks. We also know that because actuarial risk classification is never perfect, there are always intrinsic and extrinsic subsidies and often extrinsic subsidies, by which I mean this. Under the Affordable Care Act, when we say we're not going to take into account pre-existing conditions in either the availability or affordability of insurance, what that means is people with no pre-existing conditions, healthy people, provide an intrinsic subsidy to people with pre-existing conditions. Depending on how the costs break out, men may provide subsidies to women, different groups, and so forth. That's inherent in the nature of the insurance. There's nothing wrong with that. What we want to do is make a conscious decision about who's benefiting and who we want to benefit. And then extrinsic subsidies, we know lots of forms of insurance are subsidized. Medicare is subsidized. About half of the cost of Medicare is paid by Medicare payroll taxes and the premiums Medicare recipients receive. The other half is borne by the general public, and so forth. And extrinsic subsidies in other sorts of ways. Okay, so we have an insurance scheme. We think it'll accomplish certain goals. We figured out how we're going to classify risk, how we're going to set the price. How is it going to be bought and sold? Because we have lots of different models for this. So National Flood Insurance is insurance provided by the federal government, bought and sold through the write your own companies, some of which will be your homeowner's insurance, to some of which your homeowner's insurer will have to refer you. Okay, that's one way to do it. Different way to do it is health insurance. Most health insurance, except for the marketplace, is bought and sold through employers in the United States. We're seeing all sorts of new models like embedded insurance, right? You buy a Tesla, you can buy the insurance that goes along with it. Be careful. But that's happening in lots of situations as well. Raises a broader problem of focusing particularly on homeowners, where there are many more choices than auto. How well do people act as insurance consumers? I think the answer is not very well. And I think the reason is because we don't serve their needs very well. Lots of good agents out there, independent agents, lots of not so good agents. Lots of people are buying increasingly through their phones, online, whatever. But I think we could improve that market. And I raise this because we have a word from our sponsor, which is to say my sponsor. I co-direct an insurance law center at Rutgers Law School. And we spend a lot of time on homeowners insurance, but it raises broader issues about whatever insurance schemes you adopt. How are you going to sell it? So two sorts of things. If you're buying on the health insurance marketplace, go to healthcare.gov. You get great consumer-friendly information because the federal government prescribes, quite understandably, what's important and how you have to explain it's important, and then give examples, like Peg is having a baby, and under this policy, here's how much it would cost Peg, and under that, so forth. Or Joe has type 2 diabetes, and so forth. Really good consumer information. The states, no offense, generally fail at providing that. There's only a couple of states that provide anything close to that. We have a rating system. Rating system is just to get people's attention. But we have much more detailed account of what sort of information the states ought to provide to homeowners insurance consumers can make better insurance. Copies out in the lobby if you'd like. The other sort of thing, a couple of years ago, my dishwasher caught on fire. No damage outside the dishwasher, needed a new dishwasher. Didn't know anything about dishwashers, didn't even know what I wanted in a dishwasher. I do what many Americans did. I go to Consumer Reports.
You have a couple more minutes.
What we need is consumer reports for insurance companies. We've done that too. at least for some of the large national insurers. It's incredibly complicated. I don't want you to focus on the rating, but I want you to read some of the background material on what states, legislatures, and regulators need to do to make it possible to get better information to insurance. Okay, so commercial aside, but related to the insurance market. Finally, if you come up with an insurance solution, what are the external effects aside from potentially providing money for whatever you need? So, for example, there is the argument that insurance provides moral hazard. If you have insurance, you're more likely to encounter a risk than if you don't, because you won't have the financial consequences. Skeptical, we want to find out about that in detail, but think about that. Our solutions tend to focus on the financial consequences of natural disasters, for example. We also have to calculate the non-economic consequences as well of the disaster and the scheme, right? We're not just talking about rebuilding houses, we're talking about rebuilding communities. And communities have benefits and costs in ways that are not easily measurable. So, sorry, no answers, some questions.
Thank you for your presentation, Professor Emeritus, and for that to the entire panel for schooling us today. And I definitely felt the love from the panel for California. Thank you so much. With that, we do want to open it up for questions to the panelists, if we have some. And Representative, please.
So it's not really a question as much as it is a comment. So I've been in the insurance industry for 40 years as an agent, so I've seen a lot of highs and lows, soft markets, hard markets, and I will admit that this is probably one of the most unique markets a lot of us have ever seen. The pendulum swings, but I guess here's a comment, and I do chair insurance and I've seen a lot of things, and I am from the state of Wisconsin, so Midwest, a little bit softer on how the markets swing. So today we've seen the worst of the worst, and your presentation brought in 3 states that have probably the most unique challenges in the United States than a lot of the others. But I guess I'm a little disappointed in the presentation because you did only bring in the most unique states, California, Louisiana, and Florida, and a lot of their challenges are regulatory challenges. And I'm disappointed from the fact that you didn't bring in the states that got it right. Because there are some states out there that do have it right. And I am going to hold Wisconsin up as one of those flagship states. You know, we're very fortunate that we do have 282 domiciled companies in the state of Wisconsin, and we do have some that are closing out their personal lines market and aren't going to be writing personal lines anymore. But the majority are sticking with it, and we do have some high rate increases for the state of Wisconsin. I think if I told some of the other states what we're still writing homeowners and auto at, they'd tell me, Mary, I wish our states were writing it at that. But we're blaming California on climate change, you know, for their wildfires, but those are regulatory issues way more than it's climate change. I mean, we went to old gross policies in our national forests and our forests in California instead of sound forest practicing management. You know, that's regulatory issues. And I think we'd like to continue to make those discussions. Tort reform. And instead of always just saying that, you know, it's those decisions, and I think pointing out the states that did good, sound regulatory management, you know, and allowed our insurance commissioners to take those rate increases and hold competition. There's a reason there's 280 companies in the state of Wisconsin writing insurance. Let's point out why there's 280 companies, or why there's 100 companies in Oklahoma. Why is that? And I think those are the things that this body should be looking at instead of, you know, sounding the alarm and saying there's, you know, there's only, what should we do for California? Let's point out why companies are writing in states instead of trying to come up with artificial reasons to help states where there's only 4 insurers or 7 insurers, and start moving in the direction without government interference or pulling back so that there's more regulatory and free market answers for our constituents to help naturally lower and get those companies back into the states where they're not there. Just a commentary, thank you.
Thank you for your comment, Senator, and we will go to Representative Jordan.
Thank you, Mr. Chairman. I appreciate it. And while I do appreciate the comments from my colleague from Wisconsin, I think to say that I don't want to conflate issues. On the auto side, I understand that there may be some regulatory challenges, but on the homeowner side and the property side, I don't want to discount the effect that climate has had on, and I will speak for Louisiana, I'll let you speak for California. You know, we've lost, millions of acres of our coast over the last 20 years. And what that has done, that has allowed storms and hurricanes to come further and further inland, to the point that where if you're below I-10, not very many insurance companies want to write in that area. So I don't want to discount and somehow diminish or minimize the effect that climate has had on our market in Louisiana, because it's had a huge impact. Now, we have had some rules, like a 3-year rule that is unique to Louisiana that we've now changed in this session. But by and large, most of our, if I would say a majority of our issues have been related to climate. And so we are trying to get competition back in. We've done some incentive programs and some other incentives to get companies back. But that has had a really, really big impact on Louisiana, especially below the I-10. We've had Hurricane Katrina, we've had Rita, we've had Ida, Delta, Zeta. I can go on and on. We've had more storms in the last 10 years than any other state. So named storms and hurricanes. So to say that doesn't impact how insurers look at us, I just want to, disabuse that notion.
Thank you for your comment.